This is Cece. Welcome back to the Orbit. This is the first real week of the earnings season, and it kicks off for the most part on Friday morning with a couple of the large banks. So I wanted to go over a couple of things, sort of a checklist of earnings trading, and that could be whether you want to put on and initiate a new trade for earnings or around earnings, or if you have some positions going into this and like how to analyze risk. So the first thing we're looking at here is the JP Morgan chart. And as you can see with the expected move of around 3%, that one of the first things you want to check is how does that expected move line up with recent technical levels? And we're looking at a very zoomed in chart here. This is a 1 month chart. And as you can see, JP Morgan is sitting right in the middle of a 1 month range. And the expected move levels of around 141 and 150 line up pretty closely to those levels. So that's sort of an additional justification for the expected move is that they are actually lining up with technical levels, so something of interest. Looking at Wells Fargo, it's very similar, although it's more of a range of the last month. This stock is down further. The expected move is about 3.5%, which is more than JP Morgan. But as you can see, over the last 2 weeks, the expected move is, in fact, lining up with a little bit of a minor support and resistance levels just on the zoomed in chart. And then finally, we're looking at Citi. And this is it's in the middle of that 1 month range. The expected move of about 3.5% takes you a little bit inside those highs and lows. These stocks have been quite volatile the past month. And so next we're going to go and look at some of the additional things on a checklist for earnings. So back to JP Morgan, and one of the next things we're going to want to do is we're going to want to compare this earnings expected move, the way options are pricing, to prior earnings. And as you can see here, you scroll down here on the earnings tab, and you get a sense of how volatile this stock has been on recent earnings. We see everything here from a slight move higher in the last earnings to a large move of almost 8% back in April. And then prior to that, a 2.5% move and a 2% move. And again, options are pricing about a 3% move. So that's sort of in the middle of this range. But as you can see, this stock has made a large move in the last year on earnings of about 8%. Now, one of the next things that we're going to check here is open interest. And open interest is interesting because oftentimes there are certain strikes in an options chain where there is a lot of open interest, a lot of calls have been bought or sold, or puts have been bought or sold. And oftentimes those can act as support, resistance, magnets. It's how the gamma reacts on certain stock moves. So what we're going to do here is we're going to go down to the options chain, and we're going to look at, in this case, October 20th, which is the monthly expiration with the highest open interest. And as you can see, the 145 strike right near where the stock is trading is one of the largest open interest lines. But also at the 150 level, we see a large open interest. And what's interesting about that is lining up to both that technical level over the last month, those highs you see on the historical chart, but also where options are pricing an expected move with the stock just north of 145. Another interesting thing on an earnings report is obviously the closest weekly options are going to be trading at a very high volatility. But as you hover on the expected move chart out to a month or 2 months, you can get a sense of how that compares to how options are trading outside of the earnings event itself. In this case, we have about 50 vol in the weeklies, and that quickly drops to about 25 vol out a month, the 30-day IV. So basically the earnings IV is about twice what 30-day vol is. And in some cases, what you'll see is that front month vol is so pumped and so jacked that if you are playing directionally and you have a time frame that is possibly can go farther out than just the earnings itself, you might find that those options are so cheap, 30 days, 45 days out, and you're not giving that much up in extra premium for those trades that you might want to actually look a little farther out. In this case, it's a pretty typical earnings setup where the front week vol is about twice what 30-day vol is, but sometimes you'll see that 3x. You'll see it 3 times higher. And in those cases, especially if you're looking directionally, it might make sense to look at some trades a little farther out than just that week. And finally, let's look at a couple of trades using this expected move. And let's first obviously check the iron condor, which would be selling the move. And as you can see, it places these short strikes at the expected move level. We were looking on the upside with a 150 call as the short strike, and down slightly below the expected move level, we were looking on the downside at 141. And, this trade is playing for JP Morgan to stay within that 1 month range. We've seen it over the past month. The way expected moves work in earnings is that the stock will typically stay at or within the expected move about 65 to 75% of the time. Now, when it does break that and it makes a large move outside of what options we're pricing, sometimes that can be a big move. It can be a big miss. Options are sometimes completely wrong. And in those cases, defined risk trades, in this case, an iron condor, as opposed to a strangle or a short straddle, that gives you the protection that if JP Morgan were to, say, go to 155, the risk is covered to the upside, and the same thing to the downside. And finally, let's look at a couple of the credit spreads. And this is directional in that you are taking the other side of a move not happening. So let's first look at the bullish version of that in credit put spreads. So the first thing we see is an at the money credit put spread, creating a fairly close break even to where the stock is trading. So this is taking advantage of that elevated vol, and it is a fairly bullish trade in that for max gain, you want JP Morgan to go higher on earnings. The next thing to look at is the out of the money credit put spread down at the expected move. So this is essentially positioning that if JP Morgan goes lower, it will not break that expected move level to the downside, and it's risking about 80 to make 20. And of course, the mirror image to that, the flip side, is to look at those credit call spreads, which are, here is the at the money credit call spread, creating a break even a couple of dollars higher than where the stock is trading. And this is a bearish positioning, which gives you a little bit of room. You want JP Morgan to either go sideways or lower. And here is the out of the money credit call spread. This one is 2.5 wide as the strikes widen up above 150. And this is risking about 200 to make 50. And this is essentially saying that if JP Morgan does go higher, this is positioning that it does not make a new high of that chart we see over the past month.